Hi, and welcome to Market Forecast and Opportunities 2017. I'm Adam Khoo, and in this set of videos, we're going to explore the investment opportunities of this year and specific strategies on how you take advantage and profit from these opportunities. So before we start, please read the risk disclaimer by pausing the video, and once you're ready, let's continue. Okay, great. So before we talk about opportunities, it's important for you to understand the intermarket relationships between the different kind of assets. So it really all begins with interest rates, and that's controlled by the Federal Reserve. And many of you would know that after being at all-time lows, the Federal Reserve has begun to increase interest rates. It last increased rates December of last year by 0.25%. So currently the rates are somewhere around 0.5% to 0.75%. That's the target Fed funds rate. It's an all-time low. Historically, interest rates have been as high as 7 to 8%. So you can bet that interest rates will continue to rise in the next couple of years. So how does this affect the rest of the assets? Well, generally, when interest rates increase for a country, what happens to that country's currency? That's right, the currency will appreciate. So when the Federal Reserve increases rates, you can bet that the US dollar will continue to appreciate, which it has begun to do so in the last 1 year. Now, when interest rates increase, how does that affect commodities? Like gold, for example. It's an inverse relationship. When the value of the dollar goes up, gold, commodities tends to go down. And that's why you've been seeing that gold has been on quite a downtrend since 2011 because of the increase in rates. Next, how does interest rates affect bond prices? Well, generally, when interest rates go up, bond prices go down. Bonds become cheaper, and hence the yield that you get on the bonds are higher. Next, how do interest rates affect the stock market? Now, many people think that when interest rates go up, stock market goes down. Well, it's true in the short term. It's usually a temporary knee-jerk reaction. But over the medium to long term, when interest rates go up, it's a signal that the economy is improving. And hence, the stock market trends higher as rates increase. Next thing will be real estate. So the stock market tends to be a leading indicator of the economy and the leading indicator of real estate prices. And so real estate tends to go up as well as the market goes up and recovers. So that's the first thing to understand. The second thing to understand would be how to read trends. If you've watched any of my previous videos, you know that one of the best ways to read trends is using moving averages. You've got long-term trends, medium-term trends, and really short-term trends. So over here, we are looking at really the medium to long-term trend of assets. And for that, I use the 50 and 150-day moving average to determine the trend. So, quick summary would be this, right? When the market's on a downtrend, you would see the 50 moving average, which is the blue line, below the 150-day moving average, which is the green line. So in other words, when the 50 blue line is below the 150 green line, it is a confirmed downtrend. And the probability is that prices will keep going down. So you never want to buy or hold a position or go long on a downtrend when the 50 is below the 150. You only want to buy and enter the market when it's a confirmed uptrend. And a confirmed uptrend is indicated by two conditions. The first condition is that the moving averages have to stop sloping down. In other words, they have to flatten and slope up. And the 50 moving average has to cross above the 150 moving average. And when both conditions are met, do we have a long-term trend which is going up? So for example, if you look at the left of the chart, you see that the market is on a very clear downtrend with the 50 below the 150 and both moving averages are sloping down. Over here you see that the 50 crosses above the 150 with both moving averages changing their slope. And so this would be a change in trend and a time to enter the market to ride the trend up. Now, why is this important? Before buying anything, we always look at two things: valuation and trend. The valuation tells us the logic of an investment. The trend tells us the emotions of the market towards that investment. Is it bullish or is it bearish? So the mistake a lot of people make is that they think something is cheap, like the stock market is cheap, bonds are cheap, let me go buy them. But you have to remember that when something is on a downtrend, for example, if you look over here, prices have dropped by about 25% from here to over here. So are prices cheap over here? Yes, they are. They are cheap. But on a downtrend, guess what? Cheap becomes even cheaper. Low becomes even lower. So never buy an asset, no matter how cheap it is, as long as it's on a downtrend. You always have to wait for the downtrend to reverse into an uptrend before buying it. Now, similarly, on an uptrend, you never want to exit too early or you never want to sell short. As long as on an uptrend, you want to buy and stay long. Now, for example, if you take a look at the market over here, if you look at my right, when the S&P 500 was at 1,003, for example. Now, you may say at that point of time, it's not cheap anymore. You know, the market's expensive, right? It's overvalued. Fair enough, maybe it was. But guess what? It's on an uptrend. So remember that when something is on an uptrend, even though it may seem expensive, it can become even more expensive. High gets higher on an uptrend, low gets low on a downtrend. So we always look at both valuation and trend in making a smart investment decision. So with this basic knowledge, let's now take a look at what are the opportunities in the market. So before we look at the outlook of 2017, let's go back to the previous year of 2016 to see what was my forecast at the beginning of 2016 and what did I get right and what did I get wrong, right? Great. So at the beginning of 2016, January of last year, I had my forecast as well, my outlook. So was I right? So first of all, let me review my forecast for that time. Well, the first forecast I made was that the US market would go up. I was really bullish on US equities because of two reasons. First of all, at that time, US stocks were very fairly or even undervalued. And the business climate was improving. We had positive economic data beginning to emerge at that time. So I believe that the US market was going to outperform as compared to Asian equities and as compared to bonds, for example. So that was my first call. Specifically, which sector was I very bullish on? Well, energy. At that point of time, energy stocks had collapsed because of oil prices collapsing. So I believe that oil would recover in 2016 and hence the energy sector will rebound strongly from the recovery of oil. And one way to have profited would be to have bought energy stocks or the energy ETF known as the XLE. Okay. My second call was about banks. So I believe that as interest rates were going to increase at a time, as the economy began to find its footing, banks would be very, very bullish to enter as well, okay, as well as real estate. The third thing I looked at was technology, and I believe that technology would do well because it was the only area in the market that could provide real growth, where it was a moderate and low growth environment to begin with. So that was my first call. My second call was on Asian equities, specifically Shanghai and Hong Kong. So I said that these markets were relatively cheap, okay, but extremely volatile, especially Shanghai. Remains a huge challenge because of the volatility of the market, but there were many undervalued opportunities in Hong Kong that we could take advantage of. My third call was on the US dollar. So I was very bullish on the US dollar. I believe the US dollar would go up very strongly against major world currencies and Asian currencies. Why? Again, because interest rates were beginning to bottom and rise at the time, lending a momentum to the US dollar. So I said buy US dollar at the time, right? Now, how about gold? I was very bearish on gold. So I believe that gold would continue to go on a downtrend. Again, because it's inversely correlated to the dollar going up and interest rates going up. But at that time, gold had fallen quite a bit. So I believe there will be a short-term rally, short-term relief rally before gold would proceed lower. Finally, if you watch my video back last year in February 2016, I created a series of videos known as Oil with Profit from the Panic Part 2. I believe at that time oil was the greatest investment you could have made for this decade because oil had fallen from $100 to $29. And I said that oil can't remain at the level, it's near the bottom, oil will rise, you're going to make a lot of money if you buy oil. Do check out my YouTube video, which I published about a year ago on that. So I believe that oil was fundamentally very oversold and cheap and would eventually recover past $40 per barrel. And it would eventually go back to $60, $70 in time to come. So I said that you're going to really start buying oil and you make a lot of money. And the way to have done that would have to have been buying the oil ETF, which is the USO or the USL. And I called it the trade of the decade, right? Great. So that's what I said in 2016. Was I right? Let's check it out. So what actually happened? Okay. So the first thing that happened was, well, overall global markets, especially the US and the UK, did extremely well. Right? Double-digit returns on those markets. And Asia underperformed. Right? Singapore and Hong Kong and Malaysia did really, really badly. Okay. Compared to the Western countries. Specifically, the US market went up 9.54% based on the S&P 500 index and rose 13% based on the Dow Jones index. And the US market was up strongly, driven by financials, specifically banks and energy. So I really got that one right. Okay. Next one. Did oil recover? Yes, in fact, it was better than I thought. I thought that oil would go up to $40, but no. Oil went up 85% from $29 to close to $54. It's now at $55. So there was also a second call that I got right. Next, the Federal Reserve increased interest rates once last year. After holding back for a couple of months, it eventually raised rates in December by 0.25%. Okay. Now, something I did not see coming was obviously Brexit. Like most people, I thought that the UK would remain in the EU, but they voted to leave. And what happened was, global markets looked like they were going to collapse. And there was a short-term knee-jerk reaction when the markets went down for a couple of hours, in fact. And I thought to myself, okay, crap, I'm wrong this year. But amazingly, what happened? The market didn't care, and it recovered very strongly. In fact, after Brexit, not only did the UK market recover from the losses, it's up 14.43% for the year. So, wow. All right. What I did not see coming was the pound collapse. So the pound fell sharply to the US dollar to a 31-year low. Okay. Next, the US dollar did strengthen against major and regional currencies. Okay. Initially, I thought I got it wrong because for the first half of the year, when the Federal Reserve did not raise rates as anticipated, the US dollar fell. So I thought I was wrong with that. But towards the end of the year, once Trump won, okay, the Federal Reserve decided to increase rates and the US dollar went up and finished the year up. So I was right in the end. So specifically, if you look at the different markets, again, the US market did pretty well. The London, UK market up 14%. Singapore, Malaysia and Hong Kong barely broke even. Shanghai was a disaster. Like I said, Shanghai was cheap, but it was so volatile. I said, you're going to have a heart attack going. And sure enough, it fell 7% in the first month and ended the year down 12%. The only real win in the Asian market was really the Jakarta market. The composite was up about 15%. I didn't see that coming. Okay, so there's a chart on crude oil. You can see crude oil from a low of $29 or so, really went up to $54 by the end of the year. So 85% increase in oil. This is the US dollar, the dollar index. You can see again, this was the start of 2016. And then the first half of the year, the dollar went down and eventually it recovered and went higher. So there you go. So if you take a look at how the market performed for the year from this chart, it's pretty interesting. This is the S&P 500, the US market. So at the start of the year, again, I thought I was wrong initially because at the start of the year, the market dropped by 5% in the first month. One of the worst monthly drops for the last 10 to 20 years. All right, and one of the reasons for that was the collapse of the energy sector as oil prices continue going down. and did not find a bottom yet. So that's what happened at the beginning of the year. And then sure enough, once oil stabilized and oil began recovering, the market recovered very strongly all the way to July. And then we had that temporary fall from Brexit. And within less than a couple of days, it made it all back and then some. When we went into September to November, we had the uncertainty of the US elections. And so the market went sideways and dipped slightly as well. But once Trump won, and the thing about Trump, the Trump administration, is that people now anticipate that with Trump and the Republicans, they're going to be very, very business friendly, right? That there's going to be a lot more infrastructure spending, building the wall and other things. There's going to be a lot of deregulation of the banking sector. And there was also a lot of positive economic data coming out of the US in the last quarter. So that led to a huge, what they now call the Trump rally. Boom! It went up all the way there. And in December, the Fed increased interest rates by 0.25%. So that was really the year. This is the Dow Jones, which is up 13.4%. And the reason why the Dow outperformed the S&P 500 is because the Dow has more financial stocks, and finance, banks led the rallies, okay? And you could see that if you had just bought the Dow Jones at the beginning of the year, as I advised at the beginning of 2016, and you just closed your eyes, and at the end of the year, it'd be up about 13.4%, all right? If you had used the moving averages to detect the trend, you would have sold somewhere in February, gotten out of the market. As the 50 crossed below the 150, you can see you would have sold over here. Okay, you would have sold, and the moment it crossed back, you would have re-entered the market over there. Once the uptrend was confirmed, and you would have held it and rode the rally up. Okay, so I always say that we can't predict the future. We can't predict the market for 100% accuracy. But we can write the trends. And once we look at the trends and we confirm the trends, we enter on an uptrend, we exit on a downtrend, we're going to do pretty well. So, specifically, which sectors did really well? Well, once again, you can see that the outperforming sectors were banks in the financial sector, and that was the reason. And the reason is because of interest rates increasing. Banks benefit the most. The next thing would be steel stocks. Steel stocks really rallied, and that's in the material sector. Construction equipment also rallied strongly in anticipation of infrastructure spending from the Republican administration. That's in the industrial sector. And finally, energy also did really well as oil prices recovered. So what did well? Financials, materials, industrials, and energy. What underperformed would be high-yielding stocks. You see, usually when interest rates increase, high-yielding assets like bonds, REITs, and high-yielding stocks tend to underperform the market, all right? So the high-yielding stocks be things like consumer staples, REITs, and utilities. So those did not do as well. And so we got the calls pretty good last year. We did pretty well in our calls, and a lot of our students made money. A lot of our participants did really well. I had a lot of letters from them. And those are one of the reasons why we won, again, the Most Preferred Financial Educator Award for 2016. So for those of you who voted for the award, for us, thank you very much. We really appreciate it, and we hope you do very well again this year with our new forecast. So again, with the market doing really well, why is it there are some people who do not make money or did not do well? Well, it's because they read a lot of news out there that creates a lot of confusion and noise, and they read it blindly without doing their own research. So for example, at the beginning of last year, if you read the news, it said horrible stuff. It said things like, this was 15th of January last year, a recession worse than 2008 is coming. Ooh, right? And then over here it said, 13th of January, S&P 500 will plunge 75% on China deflation. Oh my God. So there are many people who read all these stuff, all these bad news, and they do not dare to invest. They don't do anything. Why? Because they listen blindly. So never do it blindly. Always do the research, and you will make a lot of money. Specifically, let's take a look at different asset classes, how they performed, okay? So the black line that you see over here this is the 20-year bond ETF, known as the TLT. This is the gold ETF, which is known as the GLD in blue. This black line represents the US stock market because it's the SPY, which is the S&P 500 ETF. Finally, the one in green would be the commodity ETF, known as the DBC. So you could buy these ETFs to gain exposure to these different asset classes. So in other words, how did they do? Let's take a look. Well, first of all, bonds didn't do too well, right? So bonds, you can see initially went up for the first 7 months when the Fed did not raise interest rates. They were holding. The moment the Fed raised interest rates or were going to raise interest rates, what happened? That's right, bond prices fell, right? Because interest rates go up, bond prices go down. So the TLT underperformed, okay? Next, let's look at gold, the one in blue. So again, gold rallied for the first half of the year after falling sharply the year before. It was a recovery rally. But again, once they saw that, hey, interest rates are going up, boom, gold collapsed as well. So gold and bonds are currently on a downtrend. Okay, and I never buy anything on a downtrend because the probability is that it's going to keep going lower until the trend reverses. So gold and bonds downtrend. Okay. Next, how about US stocks? Well, this is the SPY, and again you can see that it looked something like that. Sorry, I think I got that mixed up. Let me get rid of all these lines. So the SPY, yeah, this is the one over here. Okay. Yeah. So the US market, as I mentioned before, did really well, and buying the SPY would have net you a pretty good profit over 2016. Finally, commodities. Well, commodities, because of the great increase in oil prices, in green you can see commodities, the DBC ended up very sharply as well. So every single year, you can look at where these different assets are going to decide, am I going to buy or sell or short these 4 asset classes. So we're going to look at it for this year, 2017, in part 2 of the video. We're going to look at DBC commodities, the SPY, US equities, gold, GLD, and once again bonds, the TLT. All right. So this ends part 1 of market forecast, opportunities 2017. This is a review of 2016, and in the next part of this video, we'll be looking at what to look for 2017. So I see you in the next video. It's Adam Khoo signing off.